Rick Santelli joins us now with the bond report out in Chicago. Rick, just how important are those rates heading into next week's Fed meeting?
Oh, absolutely. You know, it's been all about the labor market, but all these moves that we had, of course, are going to be evaluated through the prism of inflation. We know the Fed's very concerned and has been mostly right about the deterioration in the labor market. But they're also very concerned, think Austin Goolsbee and others, about the inflation implications as well, which could really balance their easing strategy. Let's take a look. If we look at four-day charts of 2s and 10s, these are important because they encompass JOLTS, which was weak, ADP, which was weak, and, of course, the August jobs report, which was weak. And you can see how it looks. But it's much more than that, Dom, because really it was all kicked off on August 1st with the July jobs report. Look at 2s and 10s since the July jobs report. And you can see that really changed everything. And we're just adding on in terms of all the other weak metrics. However, if you do look at a September start, September 22, this is 3 years ago, this is where the 2-year will close if it stays at its current 3.5% yield, the lowest yield close in 3 years. Now, the 10s, they're not quite there yet. We're still comping, as you pointed out, to the 7th intraday on a closing basis to the 4th of April. Why does any of this matter? Because the 2s are really stoked for the rate cut series to begin. And in many ways, you look at a 2, it looks like a quarter point at every meeting. We'll have to wait and see. If inflation's warm, we might get a September cut, but it might stop there. It's huge, Dom. Back to you.